Welcome to Magellan Minutes. My name is Alyssa DeMarco, Investment Director and Analyst at Magellan. And today I'm joined by Hannah Dickinson, Portfolio Manager and Investment Analyst within our Consumer Franchises team. Welcome, Hannah. So today we're going to be talking about the consumer. The consumer makes up the largest part of the economy and has been a really attractive industry that we've been investing behind here at Magellan for many, many years. We've invested in luxury companies, consumer discretion, consumer staples. So what is the most important thing about that when we're thinking about the timing of when to invest behind the consumer is really that consumer sentiment piece and how they're feeling. So Hannah, can you talk to us a little bit about what your perspectives are on the consumer and how that's been evolving over the last 12 to 24 months?
The key message is really one of stabilisation. When we look at the consumer and break down the trends, we're looking at the three key consumer cohorts, so the lower, middle and upper income consumer cohorts, and there have been different trends between them. So the lower income consumer has really been through a very challenging 12 to 24 months post-COVID. They've been dealing with an incredible increase in the cost of household essentials like food, rent, groceries. So their cost of living has increased at a significant pace and they've been under a lot of pressure. What we're seeing in that cohort, luckily, is a bit of a moderation in the pace of inflation and a bit of a stabilisation in those trends. So that consumer is still very much seeking value and affordability, but they're under less pressure than they were in the past. Then when we look at middle and upper income cohorts, they've been a lot more resilient as a whole, a lot healthier, and that's been helped by a pretty strong jobs market, labour market, and a strong share market. So that consumer cohort has been quite healthy. They have seen, I guess, in the third quarter of 2024, we did see a bit of a dip in retail spending on discretionary items. And I think that was possibly related to election uncertainty as the election played out. And then what we saw was a bit of a re-acceleration into the fourth quarter. And, you know, we heard from luxury companies, travel companies, that spending did accelerate. So overall, I'd say the picture is a bit healthier than it has been in recent history. Consumers are still seeking value, they're seeking convenience, but the broad trend is a little bit better.
Yeah, absolutely. And in the payments companies that I cover, we've also seen really similar trends, which has then been boosting the payment volume growth and benefiting their bottom line. I'd really like to pivot now to really the headlines that we're seeing on President Donald Trump. There's so many different policies and initiatives that he's been talking about that do relate to the consumer, be it tariffs, immigration or diversity. How are his initiatives impacting the consumer companies?
I think what it means for consumer companies is another 4 years of a really complicated operating environment and just more headline noise. So when it comes to consumer companies, the key risk or the main issue we're focused on out of all of the kind of policy discussions that Trump has been talking about, the main one that we're looking at is tariffs. And that's because we're dealing with companies that are, you know, multinationals and often have big global, complex global supply chains. Tariffs create two risks. One is simply the need to increase prices to offset the impact to your cost base. But the other is just the kind of flow-on effects from that. So accelerating inflation again, and potentially meaning that rate cuts that we'd all hoped for won't actually be coming down the pipe. So for consumer companies, what we're thinking about is their ability to offset tariffs through pricing power. And I guess the consumer is at a difficult point in the cycle to be kind of taking on more price increases because we've already seen so much over the past few years. So when we're looking for consumer companies that are well positioned, we're looking for companies that either continue to have a really strong value proposition, so a company like Chipotle, or we're looking for companies that are relatively well positioned within their category. So a company like L'Oreal that is competing against players like Elf Beauty. Elf Beauty manufactures 80% of its products in China. So if there are tariffs from being imposed on Chinese imports, Elf is going to have to increase its prices, whereas L'Oreal, which has a lot more local manufacturing, it's going to be well protected.
So Hannah, given that backdrop that there has been quite a bit of uncertainty around the consumer sector more broadly, it's not a surprise that the consumer staples, consumer discretionary has been a bit of a laggard versus the market. But what's interesting is that there are differences within that consumer staples sector where your household goods have been performing better than food. Can you talk us through that dynamic and whether or not you view that that will continue going forward?
Yeah, sure. So just to unpack what we've seen in consumer staples more broadly is, bifurcation, as you say. So we tend to break consumer staples down into household and personal goods companies and then kind of packaged food companies. So it's packaged food that has really underperformed on a relative basis. And when we're looking at sector performance, we're always thinking about whether the performance has been related to cyclical or structural factors. So by cyclical, I mean short-term in nature and likely to mean revert. Whereas when we're thinking about structural issues or risks, we're thinking about bigger picture, broader risks that are likely to impact the category on a long-term basis. So for packaged food, I'd say there's been a combination of factors at play. So in terms of cyclical factors, it's this inflation and the price increases that we've been talking about. So because they're exposed to agricultural commodities, that there was significant inflation in agricultural commodities, and packaged food players really had to take a lot of price over the past few years to offset that impact to their cost base. So that has started to weigh on volume growth for many players, and we've seen a negative impact on volume growth and a negative impact on sentiment kind of flowing from that pricing that's been taken. Then when we think about structural factors, that kind of is a bit more of an unusual dynamic that's been going on in the sector, and I'd say part of it is related to GLP-1s or anti-obesity medication. So there has obviously been an uptick in kind of discussion and analysis of what this actually means for the packaged food sector that has been historically a real bellwether. People buy packaged food regardless of whether they are feeling wealthy or feeling poor. These are household essentials. But when we're talking about these kind of new obesity drugs that are coming to market and being adopted widely by consumers, what we're starting to see now is research and of course anecdotal evidence that these are having a real impact on household spending on packaged food. So looking at the bigger picture, there's a combination of factors that are at play. We often like to lean into cyclical headwinds if we feel that they're kind of well appreciated by the market and kind of priced in and the valuation is supportive. That's a type of risk we're usually willing to take. When it comes to structural risk like this, it's harder to get conviction in the future earnings profile of companies. So overall, what we've been doing is leaning out of packaged food and leaning into household and personal goods products, which do still offer downside protection and better risk-adjusted earnings in our view. So we're liking companies like Colgate, L'Oreal, Procter & Gamble.
Let's unpack a little bit of those household goods companies that you just mentioned. L'Oreal is one of the names that we've been invested in our global fund for a few years now. Can you talk us through what it is that you like about L'Oreal and why it still remains an attractive investment?
L'Oreal is one of my highest conviction picks at the moment in the consumer sector. I have always liked the beauty category because it's just it has a really nice structural growth profile. It's a category that's grown at about 4 to 5% per annum for many decades, and I don't see any reason why that won't continue. L'Oreal as a company is a really high quality company, and I think what's interesting about it is despite its scale, and it is the biggest player in the beauty space, despite its scale, it's demonstrated an amazing organizational agility. It's had great innovation. It invests a lot into R&D, and it's been really agile in adapting to a fast-changing consumer environment. Beauty, it's a structural growth category, but it is experiencing some unique cyclical headwinds at the moment related to China and the macro landscape there, but then also related to the US. But my view is that the market is really focused on short-term noise, and these factors are cyclical, they are not structural. So I think the investment thesis for L'Oreal at the moment is it's an attractive category, it's a high-quality player, and it's experiencing some headwinds that are cyclical rather than structural. So you're kind of able to purchase it at a really attractive valuation.
Thanks for your insights today, Hannah, and thank you for listening in. Please feel free to share with colleagues and clients.